I guess we're going to talk about the hot trend, which is interest rates finally have surpassed 7%. That means I was right. You were wrong. I was right. You were wrong.
Okay.
What does it mean for the real estate market in general? Are people pulling out of transactions right now? Are buyers a little bit more weary of wanting to get into a mortgage right now? Like, what's going on? You're in production. What are you seeing out there?
So in the last week and a half, I had 2 clients back out.
Oh.
I had 2 clients back out.
Every time a client backs out of a transaction, she calls me for an hour crying. But
No, I don't call. Not for an hour.
Okay.
It's like 59 minutes.
Okay.
Anyway, 2 clients backed out. Obviously, the rates are just way too high. The market's so volatile, right? It's like we don't know where it's going. It's just too uncertain. I think everybody's freaked out with reason. I don't blame them.
Speculation that it could get to 8%.
I think it's going to get to 8%.
If it gets to 8%, it's going to be a big problem. I can't see a buyer wanting to jump into this market with prices this high.
No.
I just can't see it.
No, and if you do the calculations, right, just 9 months ago, they were 3%.
I know, that's crazy, right?
9 months ago in January, 3%.
I was reading an article online where it was saying that the highest spike in interest rates in the shortest period of time just happened, right? So 3% not long ago, today already at 7%. And there's talks about it going even higher to potentially 8%. Some people are betting on that.
Yeah.
You know, and I mean, I can't fathom the average consumer jumping into this market at 7% and even 8%. Not with the prices where they're at. They're still historically high, right?
Yeah, nobody's buying unless they have to buy.
Yeah, I mean, you really have to buy if you're jumping in at 7%.
Yeah.
Yeah. So
and
talk about, you sent me something the other day. Talk about like the amount of buying power that just got wiped out
in
the markets over the course of the last couple of months.
All right, so I'm gonna use my phone to do the calculations.
Yeah.
So
she can't add 1 + 1. So
no. So all right. So if a buyer is buying a house at $600,000, right, putting 20% down, if the rate was 3%, like it was in January, right, and let's say the taxes were $12,000.
Forget about the tax, just mortgage and insurance.
All right, just mortgage and insurance.
I'm sorry, principal and interest rather.
Oh, what did you say? Oh,
I
yeah,
said
principal.
mortgage insurance by accident.
So okay,
so P&I rather than PITI.
So if the house was $600,000, 20% down, rate at 3.1. Let's just say 3.1 in January. $2,381. All right. So now let's do it with where the rates are today.
So that's 7%.
Which was 7%. We checked this morning. So it was 23, right? Mm-hmm. Almost $3,500.
Wow, so like a $1,200 increase.
In 9 months.
That's insane. Per month.
Per month. Yeah.
Wow. That's over $13,000 difference a year, which accumulated over time, 10 years, that's 130, even though I don't think, whoever is in a mortgage right now or getting into a mortgage right now, eventually they're going to refinance.
They will, but
once the rates come down.
Yeah, but when do you think they're going to come down? I don't think they're going to come. They're definitely not going to come down as quickly as they went up.
No, not until they can figure out inflation, right? That's a real issue. And it's kind of, all this is being done by default. Right?
Oh, yeah.
They are purposely raising rates to contract consumer spending so they can combat inflation. And that's the real problem.
Right.
And people are still spending, though.
Oh, yeah. But I think moving forward, nobody's buying a house unless you really need to buy a house.
But that's the interesting thing. I mean, we just did almost 160 closings.
Yes, but that was
rates weren't at 7, but they were like at 5.875 to like 6.5.
Okay, but you can digest that. That's not that bad. If I see a 5 in front of it, to me, it's not that bad.
But 6.5.
Once you start going, I think 6.5 is high.
6.5 is just as bad as your dress.
No, no, but
Joe
5,
agrees with me. I'm kidding, but no, six.
Okay, but
is
5
bad.
is not bad. Okay, and in
I'm going to
August,
tell you why. Wait.
No. You wait.
Don't argue with me.
You wait. In August, they were 5.
I understand.
Anybody who closed in August, no, you're not listening, because anybody who closed in August, right, last month, they locked in their rate a month and a half ago.
Yeah.
2 months ago, rates were 5.
Yeah.
Nobody wants to buy now. Now they're 7.
Yeah.
Whoever wanted to buy but doesn't have to buy is not buying. Because if whatever we closed in August, people have already locked in the rate.
No, I'm sure that mortgage applications obviously has decreased. But what I'm saying is, right, between 5.5 and 6.5, that is still historically low. That's not too bad. 5.5 is not bad. 6.5 is like teetering. I don't know. Maybe we should think about this, Martha. Right?
Martha.
Yeah, if your spouse's name is Martha. But rates, we were also spoiled with rates.
Well, yes.
It kind of also, look, let's just be honest. The rates being where they were at, 2.5% to 3%, also has caused a lot of the things that are happening right now, right? So this is what happened. COVID happened, right? People weren't spending money. Interest rates got slashed down. People, all of a sudden, all the consumers started coming out of the woodworks and started buying, right? Prices came up drastically, 30, 40%, in some regions, 50 to 60% appreciation. And now we're stuck with this, right? And now they're trying to curb inflation, and it's a problem because of consumer spending.
Yeah.
So I don't know what's going to happen in the future. I don't have the crystal ball. You don't have the crystal ball. Maybe rates go to 8%. I don't know. It is going to affect buying power. It has already, obviously, drastically. And also, I think that buyer demand is going to come down vastly in the next couple of months, and that's going to affect the real estate market.
Yeah.
And I think my personal opinion, it's just an opinion, guys, don't kill me, is the market comes down 25 to 35%. And you told me I was wrong.
No, okay.
You told me I was wrong 2 months ago.
Yes, I maybe 20. I can see 20. I don't see 30 anymore.
I can see 30. I can see 30 clearly. I can
know.
see it clearly right now.
All right. Well, we'll see what happens.
But that's good. Look, if
it needs to
prices come down 25 to 30% at 7% interest rate, I don't think a buyer or consumer is as concerned anymore about the interest rate.
Right.
They're going to step in and they're going to buy.
Everybody's just very concerned right now because the rates are high and the prices are high.
Correct.
But there are other options.
Such as?
Well, I mean, you don't have to do a 30-year fix.
Adjustables, yeah.
Yeah, you can do a 10-year ARM, right? So a client was just quoted yesterday for me, 10-year ARM, interest rate 5%.
Yeah. That's a great
rate for the current market conditions, right?
It's a great option.
If we said 5% in January, we'd be like, what? No. Yeah. But 5% on a 10-year ARM is not bad, but you have to pay points.
Yeah. Are the rates really right now at 7%? Can we call Chris?
Yes.
Yeah, we're going to call one of our mortgage vendors. And we're going to ask him what is the actual interest rate right now at this current moment, at whatever time it is.
Let's give Chris 1 minute.
Yeah. So I'm just curious to know what the interest rate is right now at this current moment.
According to our Mortgage News Daily, they are 7.08. On a 30-year FHA, it's 7. 30-year jumbo is 6.
I'm surprised. What's the 10-year at right now, the 10-year Treasury?
The 10-year Treasury is at...
Should be over 3.5.
3.773.
Wow. That is such a huge spike. It was literally at like 3.2 just a few days ago. The bond market is just very, very volatile. Anyway.
Yes, mortgage rates are now over 7%, but it's complicated.
Yeah. And if we told people a couple of months ago that rates would go up above 7%,
they would think we were crazy.
Yeah, they would be like, absolutely not. The world's going to end.
I mean,
world's going to end.
Legitimately 9 months ago, 3.1.
Yeah. So are buyers just pulling out? Because I know you had an instant where...
Yes, they are pulling out. They're pulling out. They're trying to get houses less than, what they're listed at.
You had a buyer where the buyer came in at a specific price, right?
Yes.
Over asking.
And
then in a term review, they asked to reduce their price.
No. They came in over asking. They got their offer accepted. Then before we got to the attorneys, they were like, we don't want it anymore. And I'm like, why? And they said the rates are just too high.
Gotcha.
I said, okay. And then they said, how about we lower the purchase price? If we can lower the purchase price, maybe we'll consider it. So anyway, got them to accept at a lower price. Mm-hmm. Then we started attorney review. And 2 days in, they asked to reduce the price again.
Wow.
Again.
And what happened?
Oh, the seller said no. They're like, absolutely not.
Yeah.
I already lowered it once. They accepted our offer twice, right? Once at a higher price, then at a lower price, and now we're asking them again.
But think about it. A lot of people are probably doing that.
They're scared because they just don't know where this market's going.
No, I think they're just...
And it's just too high. Yeah, rates are high. Prices are high.
Well, also because I think they were quoted... A lot of people that are shopping for a home right now, they've probably sat down with a mortgage loan officer probably, let's say, 30 days before.
Yes.
The average consumer isn't following the news on a daily basis. They don't know what's going on with rates every day. So what I think is happening is they were quoted a rate, and all of a sudden when they find out what the rate is now and they see that the payment has gone up, in some cases $200, $300, $400, they are incurring payment shock. They're like, oh my God,
right.
Are we going to go through this? I mean, do we want to? Like, are we better off just continuing to rent?
They're second guessing themselves.
Yeah, as they should.
Your price
and it's a normal reaction.
Yeah, your price is way too high.
You need to cut it.
All right, let me call him one more time.
Call him one more time.
We got a ring. He told me he had a meeting at 1, but it's not 1 yet.
Christopher, answer the phone.
He'll call me back, though. He's very good. There you are.
Hello.
Hi.
Buongiorno.
Buongiorno.
So no curse
Buon
words.
pomeriggio.
We're on the podcast. So we are talking about interest rates today, and we were curious as to where the 30-year fix right now on a conventional loan is for somebody who's got, let's say, 720 FICO score, putting down like 10% on a single family.
Right at this exact moment, the rates are in the sixes. They're probably about 6.5 to 6.625, approximately, with that credit score.
See, that's not that bad. Now, what if they were under 720? What's like the adjustment?
The adjustment is not pretty at the current moment. I mean, I just had a client that is in the high 600s that is very close to 7%. They have a high 600s, and they also have, a lot of late payments in their past. So it's one thing to have under 700, but then it's another thing on the credit profile to see that, you have a bruised credit profile, missed payments, 30-day, 60-day, 90-day lates.
Yeah.
So it takes an algorithm of all those things, loan to value, product type. So it's definitely, it's just a very volatile market. Although today we're having a massive rebound, but I think that pricing is just, secondary markets are just a little bit hesitant to reprice so quickly.
Correct.
Because they're waiting to see the dust. They're waiting to see for the dust to settle before they basically, take a knee-jerk reaction, because it's been so bad the past, week or so, that I don't think they want to like quickly, reverse those negative rates as far as, just of a one good day or one good morning of trading.
So if you're not like a top tier borrower, you're getting close to 7. Like if your credit score is not, great, or you have, some late payments, then you're getting close to 7.
You're getting close to 7, or what you're going to have to do is you're going to have to pay, some sort of, premium on top of that rate to keep it into the sixes. You know what I mean?
Like a discount.
So here's a perfect example, though. This is what I'm discussing with clients as we speak. I just got off the phone with a client before you guys called me. They are buying on a non-conforming loan limit, but they're going to go to the max, which is 960 in this area of Jersey, which is high cost area where they are looking. And rate as of today for good qualified client like themselves, 800 FICO, plenty of assets in the bank, strong income, strong employment history, and almost impeccable credit. So they're at right now, they're at like 6, just around 6.5. And that's what I'm quoting him. He's not under contract. I'm just giving him like kind of what is the going rate of today. And obviously that changes daily, and it changes sometimes multiple times daily. But I convinced him to, and not even convinced him, I really just showed the benefit of going to a 10-year ARM. Because a 10-year ARM today is trading around, we can get him into like a 5.75.
We were just talking about that. Yeah.
Yeah, so a 10-year ARM is, look, 10 years is a long time. I don't think the rates, and we can go into the weeds about this and discuss why it's going to change, but I don't think the rates are going to stay where they are for 10 years. And I think everyone would kind of agree with that. We can look at historical data and all these other things. But so you get somebody in, now all of a sudden their DTI is a lot lower, because it's more than 0.5% lower, almost 0.75 of a point lower than where the 30-year is. It's still, your payments are still at a 30-year amortization schedule, but you're only fixed for 10 years. So the second question after, laying all that out is to have a conversation with the borrower, say, what's your long-term play and how long do you think you're going to stay in the house? And, all of those questions that they have to have the discussion with his spouse to see what they're going to do. If they're going to stay in there for 15 years or maybe longer, it's probably not a bad play. I personally would do that, especially if I'm a buyer right now. Nobody can time the market as when they're going to buy. And right now, if you have to buy and housing is an absolute must for you and you don't want to rent or you're bursting out of where you're renting, you have to move, this is your next best option.
It's a great alternative for sure.
Do you think rates are going to get close to 8%?
I have no clue. I don't have a crystal ball like that.
Good response, Chris.
Yeah, we take it day by day. There's just, the inventory hasn't settled out yet. The rates, I don't think, have bottomed out yet. So that's, I don't want to be caught on any sort of recording saying that yes or no to
that. Chris, look, we appreciate your time as always, man.
All right, awesome.
All right, guys. Thanks so much.
All right, bye.
All right, so not too bad.
Should I call
6.5 if you have top tier credit, right? Close to 7% if you don't. If it's really banged up, over 7. And look, you can call 50 banks and you're gonna have.
Oh yeah, they'll all have
a lot of
rates.
banks are gonna have different rates, right? Yeah. I'm sure that there's banks quoting right now at 7 and 7.25
for sure.
Good, good tier credit. That's just the reality. But look. Here's no matter where, like it doesn't matter if it varies by an eighth or varies by a quarter or 3/8. The reality of it is that rates are much higher today than they were a year ago or 2 years ago, right? And it is affecting the real estate market. It is causing people to, reconsider, right? Buyers to reconsider, and it's also causing sellers to put their house on the market because a lot of sellers now are like, oh, they thought that they had
time.
Exactly. They thought that the market was just going to keep going up. And now all of a sudden, now there's a sense of urgency where they're like, oh, we need to capitalize right now. We need to monetize. We need to sell. And then we're going to move out of state or we'll go into rental.
Yeah.
And then figure out everything else.
That's what I'm telling my clients right now.
Yeah.
My sellers.
So the rental market will explode for sure because there's going to be a lot of demand, especially people that are selling their home now that are not ready to buy.
Right.
Right.
Or anybody who's selling their home and just wants to cash out and then they want to buy later when it comes down.
Yeah. And a lot of people are.
Because here's the thing, a lot of these sellers, so I met with the seller, she's selling her house now. Soon. It's going on the market in 2 weeks.
You actually go on appointments?
It's going on the market in 2 weeks. And her rate was 3.5.
Yeah.
And she's like, how am I supposed to buy? Like the rates are 6.5.
And you get spoiled, right? You get spoiled when you're in a 3.
So she's not
if you're going from like a 5.5% rate to a 6.5% rate, you're not going to see a lot of resistance. But when you have somebody that was in a 2.75 interest rate and all of a sudden they're thinking about selling, and when you tell them, well, the rates are like 6.5 right now, they're like, ooh, wait a minute. I don't know if I want to buy again.
So long story short, she's still selling, but she's going to rent.
Yeah. But rents are also crazy though. Like 1-bedroom apartment for like almost $2,000 when 5 years ago they were like $500 less.
I know.
Yeah, it's a lot. So Chris is right. Nobody's got the crystal ball. We don't know what's going to happen. The only thing I could say is, the obvious one is buyer demand is going to come down because of interest rates being high, right?
We're going to go back into a buyer's market.
Yeah, you're starting to see the shift now. It's leveraging, right? Buyers have a higher chance now of getting their offer accepted at asking price or even lower than asking. I see that across the board with our brokerage. People are telling me, Mike, I got my offer accepted. Didn't have to waive anything, and we got it accepted $20,000 less. Look, shout out to what's his name?
Jason.
Jason.
60K or something under. So
Jason made an offer for a client. The asking price was $660.
Yeah.
His offer is $590. He asked me, "You think it's gonna fly?" I said, "You never know. Put it in." They accepted it.
It's crazy.
In a pretty affluent area.
It's crazy.
So it's happening right before our eyes. But I just want you to tell everybody that I was right, that the market was going to shift.
I didn't say that the market wasn't going to shift.
No.
I never said the market wasn't going to shift. I didn't
you were hesitant. She was hesitant. Chris, true or not? Chris,
boys,
Joe.
I said that it was not going to go down 20 to 30%. I said that the market was already shifting, but it wasn't going to go down 20 to 30%.
It will go down 20 to 30%.
Okay, I said 10. I said 10 for sure, but now I'm thinking close to 20. But 30, no shot.
No.
I don't think it's going to go down
So
30.
if you take the, so wait.
10 to 20.
If
So
you,
we're both right.
No. If you take, right, if you take the levels of appreciation we've seen in the last 2 years.
I know, Michael.
No, you don't. And everything that's happening right now in the markets. Now, I'm just referring to the economy in general, right? The stock market. It's like if you have money in the stock market right now, you're crying. You're in a fetal position, right? Look at the interest rates, where they're at. There's no other choice. Prices have to start declining, and they need to decline drastically. Because remember, somebody who needs to sell, right? Whoever needs to sell quick, they're going to slash prices. And whatever that may look like, they don't care. They're going to start thinking, you know what?
Like
I chose to sell my house after COVID rather than pre-COVID. And you know what? I've seen high levels of appreciation. I'm okay with selling my house for 20% less, right? You're going to start seeing people that have to sell slash prices.
Oh, there's going to be
and that's
people,
the beginning. Wait, that's the beginning of the market.
Yeah, but here's the thing. There's people, that is the beginning.
Yeah.
However, there are people that are just going to sell because they have to sell. But then there's other sellers that are in the mentality of like, no, I'm not taking 10 or 20% less than what it's listed for.
Who makes up the market?
So now...
Who makes up the market?
What do you mean?
Who
buyers?
makes up, buyers or sellers?
Buyers.
Okay, so let that person hold the bag.
I understand, but now there's going to be a huge adjustment to egos for sellers.
Yeah,
That's
and
all I'm saying.
I'm
Huge
glad
ego
that's happening
adjustment.
as well, yeah, because that's very necessary.
I'm dealing with one right now.
Yeah.
No names.
No names.
No names, but you know, like the houses, they should be ecstatic they're getting what they're getting for that house, but they're not. They're like, nah, I should get 30 grand more.
Yeah.
I don't know what planet they live in, but
clearly not the same planet that you live in because of that dress. You look
We
like
matched
Catholic.
today.
You
We
look like a
matched
little
today.
Catholic schoolgirl.
You got a black shirt. I got a black dress.
Yeah. Anyway.
So, yeah, it's going to be interesting the next couple of months.
That's the end of the pod, by the way.